What if I told you the money you earn from your job should never pay for your life? I know it sounds impossible, but I've been living this reality for years. My 1.5 lakh monthly expenses are covered entirely by passive income, allowing me to invest my entire salary into riskier instruments. This approach broke me free from the cycle of working just to survive. The strategy isn't complex, but it requires understanding something most people get backwards about money and time. Most people believe passive income requires tens of thousands in capital to generate meaningful returns. They picture complex stock portfolios, rental properties, or cryptocurrency investments as entry points. This thinking keeps them trapped in the salary cycle, waiting for the perfect moment that never arrives. The truth hits different when you realize my journey started with covering a Netflix subscription. My goal wasn't ambitious. I wanted my investments to generate enough monthly returns to pay for Netflix without touching my salary. That meant finding instruments that could produce around 500 rupees monthly. Fixed deposits became my first vehicle, requiring roughly 60,000 rupees at prevailing interest rates. The mathematics seemed almost insulting compared to my salary, but something deeper was happening. This approach challenged the fundamental assumption that governs most people's financial lives. Instead of earning money to spend money, I was forcing money to work independently of my labor. The Netflix payment represented the first crack in the salary dependency system that controls how most people think about survival and spending. Friends dismissed this strategy as pointless. They questioned why someone would tie up capital for such minimal returns when the same amount could buy years of subscriptions outright. Their mockery revealed their misunderstanding of the psychological shift occurring. Each month when Netflix charged my account, the money came from investment returns rather than salary deductions. The subscription cost remained identical, but the source transformed everything. The psychological impact exceeded any financial calculation. Money generating money shifted from abstract concept to daily reality. When your investments cover even small expenses, you experience visceral proof that capital can work independently of your time and effort. This realization rewires how you perceive the relationship between work and money. Each successful payment created momentum for the next target. Cable bills, phone subscriptions, and utility payments became new challenges to conquer through passive income. The amounts remained small, but the principle expanded systematically. Money working without direct labor input became tangible rather than theoretical. This foundation separates people who eventually achieve financial independence from those who remain permanently dependent on their next paycheck. The difference isn't intelligence, luck, or initial capital. The difference is proving to yourself that passive income systems function in reality, not just in books and videos. The Netflix subscription evolved into the cornerstone of a systematic approach that would eventually fund my entire lifestyle. The specific amount generated mattered less than establishing proof of concept. Passive income systems work when you implement them consistently, starting with targets so small that failure becomes nearly impossible. The key insight wasn't the 500 rupees monthly. The insight was demonstrating that money could reproduce itself through strategic placement rather than active labor, creating the psychological foundation necessary for larger financial transformations. Years of systematic building transformed my passive income system from covering streaming services to funding complete luxury experiences. The 6 lakh Dubai trip became my first major test of whether the system could handle substantial expenses without requiring salary intervention. My portfolio had evolved into a diversified machine generating consistent monthly cash flow through dividend yield stocks, government bonds, pre-IPO investments, and gold bonds. Each instrument contributed specific advantages to the overall strategy. Dividend stocks provided quarterly payouts from established companies, while bonds delivered predictable monthly interest payments. Pre-IPO investments offered higher yield potential during market upswings, and gold bonds provided inflation protection during uncertain periods. The combination created multiple income streams that reduced dependency on any single source. The Dubai vacation cost 6 lakhs total, covering flights, accommodations, dining, and experiences across 10 days. Every rupee came from passive income accumulated over previous months. My salary remained completely untouched throughout the entire experience. This created a profound psychological shift that most people miss when they celebrate such achievements. The trip itself wasn't the victory. The real breakthrough was complete detachment from salary dependency, allowing me to deploy earned income aggressively into riskier investment opportunities. Most people operate backwards, using salaries for survival expenses and investing whatever scraps remain. This system inverts the entire equation. While my colleagues spent salaries on vacations and borrowed for luxuries, my earned income flowed directly into higher risk instruments that promise greater long-term returns. Passive income covered lifestyle expenses, transforming salary into pure investment fuel. This fundamental restructuring enables wealth acceleration rather than wealth preservation. Market volatility requires strategic adaptation within the portfolio structure. During uncertain periods, I shift allocations toward liquid cash positions and government bonds, maintaining steady income regardless of stock market fluctuations. When markets stabilize, I redirect portions back into dividend stocks and pre-IPO opportunities for enhanced yield potential. This approach enables aggressive investment strategies with salary money because basic survival needs operate independently through passive streams. You can afford higher risk positions when your rent, food, and utilities are secured through investment returns rather than active labor. The psychological freedom transforms how you evaluate opportunities and make financial decisions. The Dubai experience demonstrated that luxury and financial security coexist without compromising long-term wealth-building strategies. I enjoyed premium experiences while simultaneously growing my investment portfolio through salary deployments. Traditional thinking demands choosing between present enjoyment and future security, but this system eliminates that false choice. The portfolio had achieved its ultimate transformation from survival mechanism into wealth acceleration tool. Passive income funded immediate lifestyle needs, while salary income expanded future wealth potential. The system created a self-reinforcing cycle where higher passive income enabled more aggressive salary investments, which generated greater returns to fund both expanded lifestyle and accelerated wealth building. The 15-year timeline exposes the uncomfortable reality about financial independence that most people refuse to accept. This isn't a quick transformation or a 3-year sprint to freedom. The journey demands decade-plus commitment, and most people abandon the process because they expect immediate results that never materialize. My journey spanned 1.5 decades, progressing through distinct phases that built upon each other systematically. The first phase involved basic fixed deposits and conservative instruments that generated minimal returns but established crucial psychological foundations. The second phase introduced dividend stocks and government bonds that increased yield potential while maintaining relative security. The final phase incorporated pre-IPO investments and complex portfolio management that required years of experience to execute safely. My background provided certain advantages that accelerated the learning process. Manufacturing experience taught me systematic thinking and process optimization. Fintech exposure revealed how financial instruments actually function behind the marketing facades. Finance work at Morgan Stanley provided institutional-level investment knowledge that retail investors rarely access. However, the core principles remain accessible to anyone willing to commit long-term effort. The Pune real estate investment nearly destroyed everything I had built over 8 years. I tied up significant capital in a property that promised steady rental income and appreciation potential. Builder delays, legal complications, and cash flow problems created a financial nightmare that lasted nearly a decade. The investment remained completely illiquid while generating zero returns, forcing me to rebuild passive income streams from scratch. This setback taught crucial lessons about diversification and liquidity management that textbooks never explain properly. Putting too much capital into illiquid investments creates vulnerability during market downturns or personal emergencies. The recovery required doubling down on liquid income-generating assets while resisting the psychological temptation to chase get-rich-quick schemes that promised faster results. For someone starting at 30, the blueprint begins with understanding your personal money philosophy rather than copying strategies that worked for others. You must build systematic investment habits that align with your risk tolerance and income patterns. Chasing peer comparisons destroys consistency because everyone operates with different financial circumstances and psychological frameworks. Financial planning extends beyond personal needs into generational wealth-building strategies. Creating investment portfolios for children teaches financial literacy while providing tax advantages through various government schemes. This approach ensures the next generation understands wealth-building principles rather than inheriting money without comprehension. The 15-year timeline isn't a limitation but a crucial feature that ensures sustainable wealth building. Quick strategies collapse during market cycles or personal setbacks because they lack proper foundations. Long-term commitment creates systems that adapt to changing circumstances while maintaining consistent progress toward financial independence. Success emerges from consistent effort and disciplined investment rather than timing markets or discovering secret strategies that others missed. The pathway remains simple but requires patience that most people lack in today's instant gratification culture.